Thanks for tuning in to Talking Point today. I think we have our guests now well and truly with us, and one or a few reasons why we wanted to talk to Ambit Asset Management today. They run a fairly large portfolio management services portfolio too, about 900 odd crores, if I'm not wrong, on last count that I read, across various schemes. But the beauty of some of the things that they've written in the August newsletter is out there, and I would love to quiz their CEO, Mr. Sushant Bhansali, who joins us right now on the show, about some of those points, and then try and figure out from him how are they navigating the current scenario within their portfolio. Sushant, good having you. Thanks much for joining in. Hope all is safe.
Yeah, good morning. Hi, thanks. Thanks. Everything is safe, and I hope everything is safe at your end too.
Yeah, touch wood, Sushant. Can't complain. Let's just try and put this into perspective. So when I read your August newsletter, Sushant, it starts off with this beautiful anecdote of the letter that John Templeton had written, and how you guys have correlated it to the current times. My question is, in that letter, John Templeton says, I think, that if you are 30, 40% or 50% allocated to equities, don't overdo it because of the times that we are in. Now, my question to you is, do you reckon that the times that we are in, wherein there's a disconnect between economy and markets, and valuations have inched up a bit, warrant some bit of caution on the equity side?
Yeah, sure. So I think if you look back in 2017, probably we were in somewhere where I think there was sort of a bubble forming. And come 2018, 2019, markets have been a bit benign. Come 2020, I think in March, everything just fell off the cliff, right? And there has been a sharp recovery since then. But we are almost at the levels where we were, I think, probably November, December last year, right? But the economy is not, right? I think the economy is certainly 2 years behind us. And but markets always look from a forward perspective, right? So if you look at what will happen in 2022, I think people are expecting that what was due in FY21 will get achieved in FY22. And from that perspective, market seems to be a bit normalized. And while the broader market, the Nifty shows that markets look expensive, but if you look at the broader market per se, and you look at 80-90% of the companies, they are still trading far below, I think, their 2017 highs. Right? When the economy is probably 2 years or 3 years forward than that. So good time, I would say, to stay in market. Certainly not a time to be a bit low on allocation on equity assets. And certainly you're not, I think, crazy time like March when it was all in equity, I would say, if you would have the courage to invest at that point of
time. Okay. Just a bit of a prelude to the follow-up that I want to ask you. But there's a lot of talk around how this economy and the market disconnect stays, right? And somewhere I believe that, in all the conversations that we've had thus far as well, Sushant, is that the markets don't need to be one-to-one correlated to the economic growth any which ways, because earnings would be a different beast. Yeah. My question to you is, would you believe that the narrative of lower economic growth, lower GDP print, lower IIP, etc., will come back and bite the markets in some way? Or you think that the two can remain disconnected for a long period of time?
Ultimately, so market always follows earnings, albeit in a non-linear fashion most of the time. While we all expect that it will be linear, but it is never linear, right? Market always thinks ahead of the economy as to what will happen. And market as such is a conglomeration of how millions of people who are trading are taking decisions and what are their thoughts in terms of expectations from next 6 months or next year or so for so many companies put together. And that's how market is built up. Right. Right now, I think the expectation is that FY21 is a washout. FY22 is what will deliver what FY21 expected 6 months back before COVID hit us. Right. Sitting today, I'm not very sure whether FY22 will be able to achieve the FY21 numbers, which were expected 6 months back. Two primary reasons. One, I think the fear is yet out of our mind. I think we're still all working from home, most of the people in the metros, right? Which means the fear is still out there in our market, which means that people are not able to take risk in their business, right? So the working capital cycle, which has gone for a toss for last few months in the SME and MSME space, right? It will take a long time for it to come back, right? Probably while Russia has announced the vaccine, I don't think there is a surety around that, right? And more countries, I think, will come out with another vaccine in next 2 or 3, 4 months. And if the fear goes out of people's mind, probably by end of 2020, I would say 2023 will be FY23 rather will be a more normalized year than FY22, right?
Okay.
So it will take a bit longer, but what will happen is that while the broader market, all the companies will start in a normal fashion in FY23, there will be some winners in FY22, which will use and make most of this opportunity between FY21 and 22.
Okay, so let me ask you. By the way, I would also want to talk about gold a bit later on, since you spoke about vaccine and risk off, etc. If you have a view there, but just before that, a question to you. So there are companies that might have normalized earnings in FY23, but might not see too much of damage in the years before. Some companies might actually have normalized earnings started FY22 itself and are a bit better value. But there are these set of companies, Sushant, which are probably not going to have a major disruption in FY21 as well, right? Pharma, maybe some specialty chemicals, TMT, etc. My question is, so therefore, which pond are you fishing on? Are you trying to have a larger allocation in the FY21 traded companies, or is it in the FY22 space, or is a larger allocation for companies which are basing their recovery way back in FY23 because valuations might be better? What are you guys doing?
Sure. So we have a three separate team on a large cap, mid cap, and small cap space. But the beauty of all three portfolios is that the companies which are in the portfolio actually will, even if their sectors are getting impacted, they will be the winners in their sectors, right? So you spoke about pharma, FMCG, and other sectors, which probably are sort of taking the sheen right now because they're getting, I think, all the right things right now, whether it's an anti-China sentiment or whether it's a need for a vaccine or a medicine because of the pandemic, or because of people are staying at home and not eating out, so they are eating more packaged foods. Let's say companies like Britannia and all, right? So they are minting a lot. But there are companies in other sectors also which are not into, let's say, in a very good shape. Let's say building materials, right? So what will happen is all sectors in India, there are two set of sectors. One are sectors which are between oligopoly and duopoly sort of sectors, and then they are very fragmented sectors. In both the markets, I think there is a long tail as well, right? When their sectors are oligopoly, there are lots of unorganized play, while where the sectors are fragmented, the unorganized play is a bit less. But the tail in both the sides is very high, right? And what FY21 and 22 will do is sort of vanish the tail out, which means that the pie will remain the same in these sectors, or probably a bit low than what was 1 or 2 years back. But the market share of these leaders who have strong balance sheet will actually just grow out disproportionately in next 1 or 2 years. And all our portfolios are actually, we look at last 6 years and 10 years history of these companies and look at how their ratios are. All of them have very strong balance sheets and they are mostly leaders in their sectors. So even if the sectors are not doing well, they are not showing the growth rates of, let's say, pharma and chemical sectors or FMCG sectors, they will still be, these companies will still gain market share and show growth in earnings. So we are sort of fishing those companies.
Okay, that's an interesting thought. So what? Please correct me if I'm wrong, but what you're trying to say is that here are the sectors which may not bombed out, but have some issues in the near term. Yeah. But the good companies will gain market share and therefore show growth. And once the sectoral tailwinds come back, the growth will continue. So they might actually be better bets to bet on.
Yeah.
Okay. What themes are there? I heard you mention building materials. So is that the larger fish, or are there other themes like that too?
No, I just gave an example, building materials, just to get the perspective back. That building materials right now, because of social distancing norms and everything else, people are not wanting to get the painters, let's say, inside the house, right? While it has started gradually in the parts and corners of the country, but let's say in metros, nobody's getting the painters plating, right? But gradually that will start. But when that happens, when there is a destruction of demand, right? And there will be a destruction of the supply side as well, right? Because players who have a strong balance sheet, they're able to support themselves, their staff, as well as their suppliers, as well as their dealers. While the weak and marginal players, they'll not be able to extend the working capital to their dealers, right? Ultimately, everybody's stuck, right? And when everything is stuck, working capital takes the largest toll, I would say, to continue business in a normal phase. So in that phase, the leaders of each sector actually make the most, right? So let's say given the paints industry, right? So Asian Paints, one of our portfolio companies, the largest and only growing market share every year. They are already like 2/3 of the market, right? But they're still growing the market share. I think this will again give probably while the sector is counted market share in more perspective of the organized players, I think there is a long tail of unorganized play in the paint sector as well, right? And Asian Paints now is across the sectors. They are not just a decorative paint company, right? They are into building materials. They are into sort of putty. They have gone down to putty level as well, right? So the tail of the unorganized player, which is very fragmented play, I think that will have lots and lots of challenges in near term. And players like Asian Paints or Budget, anybody else like that, they will gain more and more market share in those nooks and corners.
Before you mentioned the name, I was going to tell you that this conversation sounds a lot like Asian Paints, because I think Mr. Singhal was on the conversation in the last 2 months twice, and a lot of what he said kind of echoes what you're saying. My question though, Sushant, is in a lot of these spaces, say paints, for example, or some of the others, even if your thesis comes out true, there are two dangers, and I don't know what you think of that, which is what I wanted to get your view on. One, the valuation risk, because you're not buying growth at a reasonable price, you're buying growth at a slightly expensive price. You have to admit that.
Yeah, of course.
Two, is there a fear of down trading, because people losing jobs, people having salary cuts, all of those are real dangers, right? And people may decide that they may want to postpone the, let's say they want to postpone the refurnishing of their homes. They can't postpone the eating habits, but they can postpone the refurnishing of the homes, and therefore, could there be a impact on the spends into some of these discretionary companies like paints, for example?
Yeah. So I think the management of companies like Asian Paints are well aware of this, right? And if you look at their strategy over the last 10, 20 years, they started, or probably if you look at 15, 20 years back when you were in college or going to school, I think Asian Paints were more luxury paints, sort of just decorative paints. Over the years, they have built their presence everywhere, right from the decorative paints to which was in interiors to exterior side to sort of waterproofing to putty now, right? Of late, last 2 years, they've been focusing a lot on putty. Putty is the last thing, right? Which is the cheapest thing, which normally you would buy from either the I think the cement provider gives you putty, or the local organized play is where the putty is. But now there's a branded putty as well, right? And also one unique thing about Asian Paints, what they did was they're ready with their do-it-yourself kit, right? And in do-it-yourself, you have to have a different mix of paints. There you have to have machines which individuals like us can work on, right? We cannot, I think, if you use the normal paintbrush, I don't think either of us can be able to paint, right? But if you go to US, I had painted a house at my cousin's place as well, right? But the equipments are a bit different. So Asian Paints is ready with that as well, right? And very soon, probably this is the time when they will launch that, hopefully, because this is the time when people probably want to do everything on their own, both on cutting cost as well as avoiding crowd.
Viewers, by the way, keep in mind, none of these conversations that we are having on Talking Point today as well or otherwise are recommendations of any nature. Sushant is just giving these examples to try and make you understand what could happen to business models, etc. So please keep that at the back of your mind. Standard disclaimer on all shows that we do.
Yeah.
Okay.
No, definitely. I think, if you give examples which are live, which people can relate to, I think the perspective sets in very easy.
Yeah. And I really appreciate that, Sushant. Really appreciate it. But I just wanted to make it clear from your perspective and our perspective as well.
Yeah.
Okay, there is one set of companies which might have issues near term, but might have tailwinds over the medium term and the long term. And the near term issues they'll grapple with because they'll be able to come out with because they'll gain market share. What about the other pockets? Since we are talking about discretionary, what are your thoughts on autos, Sushant? Where are you on this? Because the opinions are really diverse. Again, it is not as small a spend as maybe paints, and therefore the decision making is a bit distinct. But there is a low base effect of last year, and various companies like Motherson Sumi yesterday was saying that people will want to buy their own personal space in these times. My argument is that it is not a low ticket item, and therefore people might think twice before spending. What is your sense at Ambit? What are you doing with autos?
So we turned negative on autos a couple of years back when we thought that the growth rate the street was assuming. This was end of 2018 when we took a call and we sold all our auto positions, whether it was on the OEM side as well as on the auto ink side, on the large players. Right? So we sold off all the positions. Late last year, which is the end of 2019, somewhere where I started getting excited about autos, that the base effect looks good. right? So now let's start building the position. We started a bit, and then suddenly the market collapsed because of COVID. But as we speak, I think, and I would tend to agree with with Madasan Sumi management, as such that shared mobility, which was sort of playing out in the past, probably will be out of flavor for next 1 or 2 years when people would want to have their own personal space just to avoid infection. But I would say that is a short-term phenomena. This will be there only till the time the fear is in our mind. Right? Once the fear is out, once there is a vaccine, once there is a medicine, right? So the fatality rate of this pandemic is not a very high fatality rate, right? In India now it has come down below 2%. Probably, I think the number of cases which are unreported, if you count them in, I think it's less than a percentage itself. Right? It's just more fear psychosis which is playing out. So once that fear psychosis is out because of either a vaccine or a medicine, or people ultimately realize that actually this is just no more than an influenza, that's the time the personal mobility again will gear towards the share mobility, because ultimately India at least is very value conscious market, right? We all want to save money wherever we can, right? And with Ola, Uber, and everything, it has become so much convenient not to own your vehicle. You don't need to have a junket of a driver. You don't need to have your fuel expense. You don't need to worry about the insurance, repairs, maintenance, everything. So shared mobility was a concept, which will, I think, play out. At the same time, economy actually, if you look at 5-7 years, the economy has not been growing that well, right? So while auto sales have been growing more because of, I would say, availability of credit, which led to that, given that you are just taking the EMI and thinking from that perspective, right? That I am earning 10,000 rupees, even if I'm out of pocket by another 500 rupees, at least I have a vehicle of my own, right? As economic progress, I think in another 1 or 2 years, I think the two-wheelers in the, I would say, entry segment vehicles will make a comeback. The luxury segment, which is, let's say, on the passenger vehicle side, beyond 10 lakh rupees, or let's say the luxury segment within the two-wheelers, probably it will take some more time to come back. But the entry-level bikes and entry-level scooters and cars, I think, should be back both as a mixture of the personal mobility as well as demand coming back because of economy improving in next 1 or 2 years.
Okay. Sushant, can I ask you, I mean, you run 3 different schemes and therefore the mandates might be different. But considering the disconnect between markets and economy, considering the uncertainty of earnings over the next 6 months, where within those all 3 schemes combined, what would be some of the largest overweights? I understand the building materials or the home improvement and spaces out there would be one. What else fits the bill for you guys?
Yeah, so in all our schemes, actually, it's quite amazing that there are few sectors where we invest and there are few sectors we don't invest, right? So most of our investments actually are in secular sectors, right? There are cyclical sectors like financials, which you can say whether it's cyclical or non-cyclical, we don't know, right? So we fit a lot of financials. And in fact, when the times were tough in last 2-3 months, financials gave us the opportunity and we banked on going probably more on financials in all our schemes. We used the opportunity to invest, and it has, in a short period, has yielded a great result, right? So we don't invest in sectors like infrastructure, sectors like capital goods. We like to invest in consumer-linked place. India is all about consumers because of our sheer population and the penetration levels. I think anything you do, people who have, I think, created a good brand, people have created good business models, continue to win irrespective of competition coming in. Right? It's very difficult to make a large brand in a country like India, which is pan-India, because we are a continent in ourselves. Right? So somebody who has created a pan-India brand, I think they are the real winners. Just back them, and I think you mint money crazily for next 10-20 years.
Okay. One last question, Sushant, and that is on 2 spaces which are not necessarily B2C, but can be B2C also. And I've just created this niche where almost everybody believes the next big winners will come in over the decade. Pharmaceuticals and specialty chemicals. Now, you can argue that pharmaceuticals already has some winners, but compared to the global players, it's still a fraction of the pie. So what's your sense on these 2 pockets? Have you guys loaded up on them? Do you believe they're secular themes as opposed to being cyclicals over a 5-10 year period?
So we went, I think, over with pharma and chemicals. I think way back in 2017-18, right? We identified these trends that China will become a stress for global companies. And the chemical companies, especially in India, are doing a good job. I think the norms which Indian companies had in terms of pollution, whether it's pharma or chemicals, I think were much better than what were being followed in China. So we picked the way back in 2000, late 2017, early 2018, and we have been systematically adding. And I think the portfolio performance which we have been able to deliver, I think one of the primary reason is that we have been bullish on pharma and chemicals, more on chemicals than on pharma. Pharma, our thought process is that there was a wave which started in late 90s and sort of went out in earlier this decade, right? I think mid of this decade, that wave sort of, it's coming back a bit. But I think chemicals is the next pharma for India, right? The number of pharma APIs companies which got installed and we created the capacities between 2000 and 2015. I think similar thing will happen in chemicals now. We have lots of chemical companies, but they are relatively strong. If you ask on the large cap side, there's just one company. On the mid cap side, there are another 2 or 3 companies which have scaled it up. But I can tell you that come 10 years from now, I would say there will be at least 5 mega cap companies from the chemical sectors, because that's the sector which will deliver the most. It has government backing because it creates jobs. It's not a technology intensive sector, like it's a hardcore manufacturing, right? It has advantage of the anti-China sentiment, which will push people to have, I think, 2 buckets of suppliers at least from 2 countries, right? So it has all going on with them, right? And so government has come out with various schemes recently in terms of supporting their manufacturing spend, right? And it has also a bit of R&D element, which otherwise is not that critical as compared to pharma, right? And India will be more about intermediary, not about the, I think, innovators in terms of where the crop, whether it's agri side or whether it's consumer side or whether it's pharma side. I think everything is chemical ultimately, right? Even the pharma, if you look at it, was more chemical than a pure play pharma, right? We were supplying to the pharma companies, right? But it was more about the supply chain, and which is what I think the specialty chemicals will become the biggest one, I would say, in next 10 years. That would be the biggest theme.
Wow. Well, should be music to ears for a few people who are invested in this theme. But Sushant, it was a pleasure talking to you today. This is the first time that we've interacted on BloombergQuint. I look forward to having you more often on our platforms.
Sure, Niraj. Thanks a lot. Thanks for your time, and wish you all the best.
Yep. Stay safe, Sushant. Thanks so much for joining. Viewers, thanks for tuning into this edition of The Talking Point. Thanks, Sushant. This was lovely.
Thanks,
Stay in touch.